everyone. So I'm Anthony Rose. I've put my details in the chat. Feel free to connect on LinkedIn. I'm founder at a legal tech company called Seed Legals. We're a 160-person company. We've got about 50,000 startups on our platform. I talk to literally thousands of founders every year. We've got data for thousands of startups, and I love, apart from running a 160-person business where I'm founder and CEO, also love helping founders avoid the mistakes that others make and getting to grow sooner. So we're going to talk about how to get investment ready, find investors, and close your next round. So that's all about the investment side, that I can never help myself talking about the product side first. But before I do, a little bit of background on me. I'm these days 2 weeks UK, London, and 2 weeks New York. Right now, I happen to be this week in Bulgaria, so welcome. That's just on holiday. But Seed Legals is largely based in the UK, now expanding to the US. I used to head up BBC iPlayer, that's the UK's version of Hulu and Netflix, led a very large team, and then it was time to get back to startup roots. So I built a startup, sold it, built another startup, sold it, got tired of paying lawyers, and built Seed Legals. So Seed Legals, about half of all startups in the UK are on Seed Legals, about 50,000 companies. About a third of all fundraising in the UK goes through our platform. And with that market share, it's time to expand. And so we now have Seed Legals in the US, and we'll get to that in a few minutes. But I'm not here to talk about Seed Legals. I'm here to help you. So the very first thing is, all founders, you have an idea and you're going for a run or you're in the bath or wherever you have ideas and you think it's an awesome idea. And you think the difficult thing is building it. And one day, in a year or two's time, after you've raised investment and after you've got team members to leave their day jobs and follow you, and you've given up your day job, you wake up in a cold sweat, realizing that nobody wants your products. And every first time and often second time founder has been there. I really want to start way before I talk about the fundraising part, is about validating the idea. So who here knows the mom test and has read the mom test? I'm guessing most people have. If you haven't, it's, I don't know, $15 on Amazon. Go get the mom test. So why is the mom test called the mom test? It's, imagine, let's say you've got an amazing idea for this blockchain-enabled, AI-enabled bicycle lock that will find your bicycle automatically if it's stolen, because your bike got stolen and you now want to make sure that it never happens to you and other people again. So you come up with this idea. It sounds amazing. And of course, you don't know who to ask about it. So you ask your mother, and your mother knows no idea what you're talking about. But she goes, my son, such a clever boy. Of course, it's a good idea. So you ask the wrong question to the wrong people, and you get the wrong answer. And that's why it's called the mom test. And instead, what you need to do is go find actual potential users of your product, in this case, people with bikes, and then ask, don't say, isn't this an amazing product? Because they won't want to be embarrassed and say it's not, or the way you've described it sounds so awesome. Instead, what you want to do is ask, have you ever gone and looked for one of these? How much have you paid for it? How much would you pay for it? What are you using right now? Name 3 competitors. And if no one's ever looked for this product, it's possible that you've got like a category defining new product, but that comes along very infrequently. More likely, it's a vanity product and people aren't really looking for it. And you're going to spend a lot of time building it and then realize only later that people aren't really looking. And you can see I'm like going over again and again that you really want to validate before you build it. And we're going to talk about how to do that in a minute, because I've just seen too many founders and too many websites that I can just see people building stuff and I just can't see people wanting it. So you've now done some elementary testing, you've asked people, and as I was saying, the hardest part isn't building it, the hardest part is people getting to want it. So how can you cheat and get there faster? And I call that fake it till you make it, but not Terranos style. So let me turn off screen share so I can wave my arms a bit more and talk a bit more about that. Once upon a time, it was said, build it and they'll come. the apartment block you live in. They built it, and then people came. And then came agile development and MVPs and mock-ups, and you create a mock-up and then you test it. And of course, that's gotten dramatically easier because until recently, you just had to use tools like Figma and others. You could make a mock-up that people could use on their phone. So if you're making an app, you can actually make in a small amount of time a mock-up. It doesn't do anything. And you go, try it. Tell me what this app does. Don't tell them what the app is, just give them your phone and say, tell me what this app does. Finding somebody who's a potential target user. So if you're doing things for wills for 80-year-old people, go find an 80-year-old person and show them. Don't show someone out of college. And then ask them to go through the screen and see what it says and what's the problem it solves for you. And okay, great. Now click the button to get started. And if they just get stuck, you've got a problem. And the good news is because it's a prototype, a mock-up, it's cost you almost nothing to make it. You haven't hired people yet, and you haven't written lots of code. So when you want to update it or change it, you just go back to whatever mock-up design package you used and modify it until people go, oh, I know what this is. I've got this problem. Let me click to get started. And then you've got a potential winner subject to pricing and so on. But of course, the rules of the game just changed dramatically here with the arrival of Lovable and others. And these days, you've got no excuse for not using Lovable. If not to build a mock-up of the app, I'm not in any way suggesting it's going to be production code or usable in any way, but you can just get it to make that mock-up and you can make a website. And one of the party tricks I have is that when I'm talking to a founder, founders often reach out to me going, hey, Anthony, I'm fundraising on your platform. Can you do me a favor? Can you review my pitch deck or my website? And I'll, subject to time, I'm delighted to, like a 5-minute Loom video, go through their website or pitch deck. But the party trick I've got these days is I go to Lovable and by the way, I use Whisper Flow, which is voice to text. So I avoid typing these days. I can just talk, turns it into text. It's amazing. Party trick for everyone. It will change your life. But I can just go to Lovable and say, make a better version of, insert the URL of the site, do a competitor analysis, finding other companies, and there I might list some that I found myself, offering a similar service, show the problem that this company is solving, demonstrate some screenshots showing how it solves the problem, include some customer testimonials, add a pricing screen, make sure there's a get started and a book a tour or book a demo or contact us button, and add vibrant colors and lifestyle images. And in the time it takes to go make a cup of coffee, I've got an Italian machine that takes 10 minutes to warm up. Amazingly, without fail, Lovable blows my socks off with an amazing present website. I usually use this for a website. Sometimes you can use it for a pitch deck, but for a website, it's amazing. And it's almost always better than the person whose website I was looking at. Why? Because it says in big letters at the top, the problem that you're solving. And this is the real issue with most websites. And I have been there myself with Seed Legals. So the problem I see with most people's websites is essentially they're saying the problem you solve, sorry, you're saying what you do, which is like showing how clever you are. So if your website says we use blockchain and AI to change insurance, 0 people have that as a problem that they woke up to today. And 0 people are going to go, this is exactly what I need. So if, however, you changed it to show a picture of a homeowner or a car owner or something like that, or a car with a ding in it, and it says, we can save you 30% on your next month's insurance. We use AI and smart stuff to do that. Suddenly, everyone going there goes, oh my God, that's exactly what I need. So your website and your product should always be about solving a problem that somebody has. So Lovable or other design tools are the way to do that. The other thing is fake it till you make it. Now, what does fake it till you make it mean? Is many founders are technical founders and they just love building stuff. But it took me like 20 years and several startups to realize that building stuff is the failure to have a product without having to build stuff. So what if you could have a great product without having to build, or at least something that may not be scalable? So I realized this in particular when I was doing a workshop at an accelerator, and there was a startup telling me that they match people with events or wanting photographers with events for events with photographers. And they were telling me they're hiring 5 machine learning developers to match photographers and people. And they'd raised like the better part of $1 million. And I thought this was just insane because when I looked at their website, it basically is as simple as I'm looking for a photographer for this event. And all they needed to do was just make a website in Squarespace or Webflow, whatever they want to do, put a type form field in it saying, tell us about your event. Where is it? What area code is it in? Or what state is it in? And so on. How many guests and a few fields. And then the type form could use Zapier and could send them an email. And then they could look it up in an Airtable that they've created. And initially, they'll probably only have a few dozen photographers. And so this entire concept they could have tested with 3 days of work and zero money rather than spending a fortune. I think they pivoted into something else afterwards because there just wasn't enough business there. So what you want to do is you want to do the non-scalable thing, to do things manually, to avoid having to build lots of stuff, if at all possible, before you go and build it for real. And a great example is actually at Seed Legals ourselves. So when we launched, we had to build a platform, and we had to build all the document automation to create funding round documents, which is very non-trivial. But we couldn't make an MVP so that if you want to do your funding round on Seed Legals, we say, your legal documents, it's MVP. It may or may not be good law. Obviously, that's not the go. But what we could do is have the website look like a super cool, beautifully designed website. You enter your deal terms, but then it goes to my lawyers and they use Microsoft Word to build the document and then they upload it to the site while we work out how to code it and also while we work out what features people really need. And so that's exactly what we did. And we learned that about half of the features that we thought people needed in a funding round, they didn't want. No one was interested. And half the things that we never even thought about is people did want. And so by going this route, we saved ourselves a lot of work building stuff that would have been thrown away, and we could rapidly build the things that people really wanted. And of course, when my legal team started screaming, help, Anthony, you're killing us, we're dying here, we can't do it, then I knew it was, okay, great, we found some product market fit. We now need to go and automate that. So where I'm going with this is you want to get your product out in the market with the least amount of work, because that's the way to validate it. And of course, the one way to do it is to see if you can do a mock-up for testing, but that doesn't get in the market. Getting in the market means perhaps doing things manually, and in particular when there are AI solutions, while you're still working on the AI, you might do it manually in the meantime. By the way, if anyone's got any questions, feel free to hop in right now or put them in the chat. Okay, if there are no questions, I will
Oh,
continue.
I may
Yeah,
just have,
John,
I guess, a
go
comment.
for it. Yeah.
Yeah, so I guess since I've already have, I guess, like several years experience, like big tech, like working at Google Cloud and like AWS, I've basically been using hackathons like to do that type of MVP type of work, which is if you enter enough of them, you'll basically just get practice and be better at it. So like when you actually do it for your own startup, I guess I'm doing it from a hackathon product, so it basically is becoming a startup. So yeah, it basically gets you prepared. So that's like a good, I guess, like method in terms of that's what I'm doing. But it is stressful. So like you do have to like pace yourself and like, not enter too many at the same time, or pick the ones you want because there's like tons of them in the city. So like you have a lot of choices like
Yeah,
constantly.
and so that's a great point. Thanks for sharing. I judge hackathons occasionally, and I think there's a good part and a bad part to the hackathon part. So the good bit is it forces, like in the next 24 hours, I've got to build something. But what's not good with hackathons is there's no real validation. The winner on a hackathon is based on the presentation. You could say, we've built a system for going to Mars. We don't have the working version yet, but we promise Mars flights at a lot. And everyone goes, that's amazing, we're in. But the reality is you have to build it. The people judging hackathons are often not your actual target users. They're hackathon folks, and they may not be little old ladies that are going to buy your products and so on. So be careful with hackathons. It's fantastic for forcing, we're just going to build stuff like super fast and have a great presentation, that it might be a false positive for people who think they are telling you they love it, but actually it's not realistic. And by the way, I'll add one more thing, which is in this timeline of once upon a time, build it and they'd come. And then there was agile development, which is build a prototype or an MVP quickly. And then there's build a prototype using Figma or Lovable. But I think you can go a step further. And what I like to do is now I write the press release. And only if the press release essentially gets picked up, do you then go and build it. So, for example, if I want to build some new product on Seed Legals, I might do a LinkedIn post saying, working on this, if this is of interest to you, as if it not as if it was built, because obviously then people go, I want one, they go, sorry, dude, I haven't really built it. But to make it look as if it's something that is about to be built. And if no one's interested, then it's a good signal that you may have to work super hard and pay for advertising, because it's not cutting through the noise. And these days, there's so much noise that you really have to cut through that. So listening to Olivia with EdTech and so on, EdTech is a huge area, as is MedTech and many other things. How do you cut through that noise? And instead of describing it as an EdTech product, it is the fastest way for kids under 5 to learn how to write, I don't know, whatever it is. And now you've got your differentiated product. Okay, and we may get back to that. If anyone's got any questions on that, pop it in the chat. And we're now going to switch from product to fundraising. So where you're at so far is you've had an idea, you've got the mom test, you've asked people, you've made a mock-up, and you now are sufficiently feeling that you've validated that you want to go build it. So, of course, at some point you need to get some funding. Maybe the first thing you do is go and incorporate a company. And here in the UK, I found basically 100% of companies are just one company type. In the US, there's two company types, and of course, lots of states. And it's well known that to fundraise, you need to have a Delaware C Corp. And we'll get back to a moment whether it still is Delaware or not. But I was quite surprised when I started talking to founders in the US. Maybe about a third of them have an LLC instead of a C Corp. So if anyone here has an LLC, maybe raise your hand. And otherwise, but very briefly, LLC, limited liability company, is something that's great if you're an Etsy jeweler or Shopify person and you've got one or two founders who have this company. An LLC is a pass-through tax structure. So any profits get sent essentially, and as if the owners of the LLC were paying tax on it. But investors don't like investing in LLCs. None of the investor agreements are designed for LLCs, and they don't give the investors the tax benefits, QSBS, that I'll get onto in a second, that comes with a C corporation. So if you do have an LLC and you're planning to fundraise, really before you go talk to investors, or at least before you take their investment, you're going to need to convert that into a C corporation. Now, once upon a time, all C corporations were in Delaware, and then Elon began tweeting that I'm over Delaware, and a couple of others have done that. And I want to make sure that I advise my customers the correct advice. And so every time I go finding a startup lawyer or an investor, I tell them, do you invest in C Corps in other states? And I would say the 99% use case is, dude, you need to be a Delaware C Corp, because Montana is fantastic, but lawyers in Montana know a lot about castle rustling and not so much about startup fundraising. And so your goal as a founder is to minimize the friction in finding investors. investors talk to any individual investor talks to many startups. And so for them, anyone that adds more friction, it just goes to the bottom of the list. So if there's somebody going, I'm a couple of founders, have a Delaware C Corp, can offer you QSBS tax savings, working on a B2B SaaS app, whatever it is, I'm ready to go. That is little friction. If someone says, I've got a Texas C Corp or I've got an LLC, then the investor has to figure out how it all works with a Texas C Corp, what the laws are, does their lawyer know it? Their lawyer probably doesn't know it. And so things are more complicated. So where I'm going with this is to minimize the friction with investors, you want to have a Delaware C corporation. And lawyers would typically charge $3,000 to $5,000 to convert an LLC to a C Corp. So if you are starting your company, it's much more cost effective to just get on Stripe Atlas or something like that and make a Delaware C Corp from day one. If you've got an LLC company, I'm about to launch on Seed Legals a nice slick way of turning that into a C Corp for about less than half of what lawyers are charging, because I've realized there's a giant market right there. So let me go back to screen sharing and screen share. Okay, so we've covered LLC or C corporation. And the next thing is QSBS. So in the US, there are two really good tax savings for investors. And it's super important that you know about these, because if you tell your investors that you can offer these and other people aren't telling them about it, you may have an advantage, because the investor goes, oh, wait, these guys can offer me something. It may turn out that all startups can offer, but since others don't know, this is your advantage. QSBS, for those who don't know, I reckon probably about half of investors and half of founders know. QSBS, qualified small business stock. This means if your company has less than $75 million in assets, check, then you as a founder, so this is great news for you too, and an investor, if you keep your stock for 5 years and sell it after that, you pay no federal capital gains tax up to the greater of $10 million or 10x your investment. So as a founder, if you exit and sell your company for 100 million, let's say, and you've got 30 million, 30%, let's say 20% equity at that point, that would be 20 million you're getting, and you're going to pay no federal capital gains tax on half of that, and also no state capital gains tax in many states as well. So QSBS is something that many investors look for and will pick companies that can give them these benefits. And most startups will be eligible and will comply so long as they're a C corporation. LLCs don't. The other thing with the QSBS is you have to keep your stock for 5 years. So for you as a founder, you get your stock when you incorporate the company, so that's obvious. But an investor, if you've been raising with safes, it's unclear whether the 5 year clock starts when the investor invested with a safe or 3 years later when you converted their safe in a funding round and they got their shares at that point. And weirdly, because there's hundreds of billions at stake on this, the IRS has not offered a ruling on it. So some investors go, yeah, when I get my safe, my 5 year clock starts. And others go, no, my 5 year clock starts only when you issue my stock and convert my safe, or you do a price round and give me stock right now. So we can get back to questions on QSBS in a minute. The other tax benefit for investors, which it turns out literally zero people know about, I'm quite amazed, is something called Section 1244 loss relief, snazzy name. And so what that is, QSBS helps the investor if your company goes well. Section 1244 loss relief helps the investor if it doesn't go well. And the sad fact is a good fraction of startups don't work out. And if the investor's money goes to zero, they've lost it. But this loss relief means that in the tax year that their investment went to zero, they can write off and up to $50,000 per year from their taxable income or $100,000 a year as if they're a joint filer. And they can do this if they were an angel investor, in other words, investing personally, and the first $1 million into a startup. So if you're
Um,
raising, and there was a question from somebody, or someone
oh,
else just,
I feel like if are you able to put your mic closer because it's a little hard for people to hear you. Yeah.
oh, let's just see. Is that any better? If not, let's just try once more. Is this any better?
Yes,
Yeah,
that's
that's
way better.
better.
Oh, wow. Okay. All right. Thank you. I'm not sure what the difference is, but okay. Awesome. Okay, great. And by the way, if anyone's got any questions, please do hop in. All right. And sorry if the volume was low. So on the snazily named loss relief, this means if your company goes out of business and you have raised from friends and family and so on, it's the difference between an unpleasant Christmas dinner conversation and still being invited to Christmas dinner next year, and the investor can recover some of their loss against their income tax. So it's something that is a good thing for investors and something for you to know about as well. Now, this loss relief requires that the investor has stock in your company. So if you've raised with safes, and the safe hasn't converted while the company is still at a value, then the investor can't claim this anymore. All right, so now we're going to get on to fundraising. And I'm going to talk about, actually, before I talk about safes, I'm going to talk about how to find investors. So this is one of the most important things for any founder, of course. Where do I find investors and who do I find as an investor? The problem that many founders have is you don't know any angel investors. Where are these angel investors? They don't have websites. Where do you find them? So you start Googling for early stage funds, you find those lists of funds that people have, and then you start writing to these funds. And chances are high they'll never write back. And if they do, and amazingly you manage to get a meeting with them, then the problem is the story of your life is love what you're doing, come back later. Because the problem is funds typically, and with rare exception, don't invest in pre-revenue startups. So they will require that we come back when you've got some revenue. But this doesn't help you. It's a catch-22. Who's going to give me money to get to revenue? Now, of course, you can bootstrap it yourself. And there's a bit of a Twitter theme these days about seed strapping. This is that you don't raise as much money. You get to profitability. It's a bit of a rubbish conversation because you can only bootstrap if you're independently wealthy. Otherwise, you run out of money, you can't pay yourself, you can't pay others, and you get stuck. So you really have to raise. And of course, you could try to get some revenue into the business and then grow organically, which is great. And if you can do that, that's amazing. But it's usually going to limit the rate of growth of the business because if only you had a salesperson and only a marketing person and only like another developer. Otherwise, I've just got this one person and he or she's gone on holiday and I'm stuck for the next 3 weeks. So funding it yourself works if you've got enough money to do it and you can be on the slow train, so to speak. But your life also has value. And so you're much better off as soon as you've realized that your product has legs and that you have developed enough that you can raise at a valuation that means you're not giving away too much equity for the amount that you want to raise. And this these days generally means you've built a, if not a prototype, it means that you've built something that's now live, because that's easier than it used to be before. It means you don't necessarily have to have customers yet. You definitely don't need to have revenue. But that also means you're not going to VCs, you're going to angel investors. So who's an angel investor? An angel investor is basically anyone. Early stage startups are going to raise from people who are investing between 10K and 50K or 100K. If you're looking to raise 500K, that could be 10 people at 50K each. So angel investors in the early stages are your friend because They don't want a board seat. They're not going to get you fired. They're not going to want information reporting. They're not going to want to spend thousands on legal fees. You're going to start off by finding angel investors. And then the question, of course, is where do you find angel investors? Because they don't have a website. And that can be a whole other talk. But very briefly, here's my suggestion for finding angel investors. And of course, you guys may be awesome at it if you're influencers, or you might be going, oh my God, I am a bit of an introvert. I have 20 people following me on LinkedIn. This isn't going to work. So the first thing I think is content marketing. So that is writing blog posts, articles, getting your content in magazines and so on in your area, and getting the word out. So when people Google you, instead of seeing like nothing, you don't exist on the internet, they start seeing these articles everywhere, and then start sharing these articles on LinkedIn and build a LinkedIn following. It's important for a founder to start building that social presence. And suddenly you start appearing in people's feeds and start talking about the problem that you're solving. Start talking about interesting problems in the space and being a thought leader on it. And the more you do on this, the more you're going to start people following you and asking you things. And now you can start talking about the project that you're working on. You can mention that you're fundraising. Don't make it a sort of spammy financial promotion, but make it in the context of we're looking to change this. Such and such is broken. It's crazy. So many children, whatever it might be. Welcome to this. We're changing that. So content marketing. The other thing, of course, is work on SEO, but that's going to be a slow burn. The next thing is start reaching out to people on LinkedIn directly. And here, if you know the term SDR, sales development representative, those are folks who, when your company's larger, you'll hire to do LinkedIn outreach, which is one of the more effective sales channels for many types of businesses. You're going to start finding certain types of people. Maybe you have to use LinkedIn Navigate or maybe not. And then you start writing a sequence of messages to them. So, for example, one thing that I do, or rather my team do on my behalf now, is, for example, there's a newsletter where they very cleverly, the people write the newsletter called Poach VC. They identify founders who switch their LinkedIn profiles from working at Google, Meta, or wherever it is to stealth mode and a few other things. And then they figure out that they're probably fundraising. And then they go into the newsletter, they get listed in the newsletter. The founders don't know this, so that investors can start tracking super early signals of founders. And then what I do, because I like to, of course, use this as a signal for finding customers on Seed Legals, or rather my team do. So then we drop them a note saying, hey, I spotted you in the Poach newsletter. You might be fundraising. Would love to tell you more about what we do and see if I can help. And so maybe 30% of people respond. So you can start finding people doing interesting things in the space. You might find investors who've invested in other things in the space. You might find people who've posted on things. So start using some LinkedIn outreach and don't be embarrassed about it, but make sure it doesn't come across as spammy, because if somebody messages you saying, I've got a surefire thing that's going to change the world, we're raising, can I send you a pitch deck? Okay, that was like far too strong. But if it is, hey, I saw you did an article on something, or you posted on this, I can see you're passionate about this, I'm working on something in the space, can I tell you more? And it's the sort of thing that sounds like, yeah, why should I not accept that invitation to connect? I'd like to learn more. And now you've got the person's attention. So you should think of investor outreach like a Netflix series. The goal of episode 1 is to get you to watch episode 2. You're not going to get the investor to invest right there from the beginning on one outreach, of course. Each one is the cliffhanger to get you to the next, and such that by the third or fourth, okay, great, we've spoken on a call, can I send you a term, a safe or something like that? Might I tempt you to invest 20K, or whatever it might be? So you want to play that game. And for many founders, it's a little uncomfortable, right? You're not used to this. You're a bit of an introvert, but you need to become that salesperson. Some founders naturally are. I think most founders are. If you know your Myers-Briggs profile, INTJ or INTP, you're an introvert and you'd like nothing more than to write emails, listen to some music, and never talk to a human being. But you have to reinvent yourself and you have to get out there to pitch. Talking of pitching, I'm going to switch to the art of the pitch. And I see, and by the way, judge many pitch competitions and also pitch practice sessions. And so pitches, let's spend a moment on those. Pitches you might put into three categories. The 1 minute or 3 minute pitch that you might do at a stand-up event. Maybe there's a 5 minute pitch that you might do in a room at an event. And then you've got your 30-minute investor pitch, which might be online or might be in person. And what's the formula for that pitch? In all cases, you're going to think about it like that Netflix drama. It's a story that you're telling. You start by explaining a problem. And I think all pitches are of the form, something is broken, it's insane, here's how we're fixing that, here's more information on what we're doing, meet the team, it's a huge market, here's some competitors, here's our business plan, here's our 5-year revenue model, here's the traction so far, and don't forget the last slide, here's the ask. Now, obviously, if you've got a 1 minute slot, you're not going to get much of that in. You're just going to get something is broken, we're fixing that, here's my backstory, we're raising, here's the ask. And don't forget to make sure your name and your company name is signposted everywhere, because too many pitches I see, at the end of the pitch, you think to yourself, and you should do this next time you watch someone else pitch, right after the pitch, you think, what is it that they do? And what's the company name? And what's the URL? And if you can't remember it, that was a completely wasted pitch because no one's ever going to follow up with them. So you need to make sure your branding is throughout. For example, at Seed Legals, my pitch might be fundraising is broken. People spend $50,000 on a funding round, paying lawyers like $1,000 an hour so they can exchange Word documents between them. It's insane. It was time to change that. Hey, I'm Anthony. I built startup, sold, tired of paying lawyers, built Seed Legals. We're 160 people, 50,000 companies. We're raising, contact me at, and there we go. There's your story arc of having shown a problem, how you solve it, found a backstory is always great. And then you get on to not forgetting the ask at the end. Obviously, if you've got a 30-minute slot with an investor, then you want to make sure that so this is really important. Many people, when they get a 30-minute investor meeting, they just talk at the investor for 30 minutes. This is a waste of time for a few reasons. Firstly, the investor would love to talk as well. They want to have an interesting conversation with you. The other thing is your pitch deck, of course, is fixed, but investors are all different. They love different things. Some investors are the spreadsheet guru. They're going to look at your TAM and your SOM and your 5-year business plan and your revenue model, and they're going to work out your net present value and all this other stuff, and they're going to go, this is a business I would invest in or not. Others want to save the planet. They may know that the business isn't going to be wildly profitable, but it's doing good. Others might want to hang out with the cool kids, and they go, that sounds amazing. Some might want bragging rights, say, I was the first money in on this company. And others might want to be founders themselves. So they're going to say, I'd love to help you. I can make intros, and can I help on the product? And of course, at some point it goes, dude, leave me alone. Can I just get your money, please? So by talking to the investor at the beginning of the conversation, you can ask them, tell me, obviously don't ask anything that you could have discovered on their website, because that's just going to indicate you haven't done your research. But you might ask, what's the current thesis? What are the things you're most looking out for? A really important question to ask if you're talking to a VC is, are you a lead investor or a follow investor? So founders only discover the difference between lead and follow investors after they've wasted a lot of time in a catch-22 with an investor. So a lead investor is somebody who says, I love what you're doing. I will send you a term sheet, or I'm in. and I will set the deal terms with you, and then you can bring on other investors if you like, but I'm in. A follow-in investor is somebody who says, that sounds great. Call me when you've got a lead investor. And so you may find yourself in the position where you've got a whole bunch of investors interested in investing, but none of them will jump first until you've got a lead investor. What I like to do is early on in the call, if I'm talking to a VC, ask them, would you lead the round or would you follow? And if they tell me they lead, then I want to see, can I get as close as possible to at least not closing in this call, but establishing that we're good to go to the next step. If they tell me they're a follow investor, the best I can do is keep them warm to get back to them when I've got a lead investor. So all of which is to say, if you've got a 30-minute pitch slot with investors, with a VC, maybe get them to talk for 5 minutes or so, then you can start going through the pitch deck and then make sure you do the whole pitch deck in 10 minutes so that you've got a good amount of Q&A and general discussion at the end, because that's really where the decision happens. Otherwise, it's at the end of the call, it's like, okay, you've shown me all the stuff and now we're done. And what am I meant to do? So that was the 101 on investor outreach, the art of the pitch, obviously super compressed here. And now, lastly, I'm going to get on to fundraising and safes versus priced rounds. So let me turn on screen share for just a second. Okay, so we're going to talk about how much to raise and how you raise and the amount of dilution. And we're going to do that all in about 5 minutes or less. So let's begin. So most founders are reasonably sensible in coming up with the amount they want to raise in their first round and the valuation that they want to raise at. But I must say, some of them come up with what numbers that are crazy high. And if you're a serial founder who's exited your last company at 100 million, you can, or the ex-CTO at OpenAI, you can raise it substantial amounts. But for the rest of us who are not, if you say, I'm raising $5 million at a 25 million valuation, and your investor goes, that's amazing, what have you built? And you say, I've got this here level prototype, they're going to say, come back later, because there's a giant disparity between the 25 million valuation and what you've built. And the problem is many founders spend far too much time looking on TechCrunch at crazy valuations and think that's the way. But I think most investors know that startups are in one of several buckets. So it might mean you're going to raise $100,000 from friends and family, right? This is super informal, obviously with safes and so on. Then you might raise $500K to $1 million, maybe on a 5 million or somewhere between 5 and 10 million post-money cap valuation. Or you might, well, between 500K and $1 million, and that's your sort of pre-seed round. And then you may raise $2 or $3 million at, again, you multiply the valuation by 5 to get the pre-money valuation. So what we see is that founders dilute typically 15% in a funding round. So if you take the amount that you want to raise, multiply it by 5 to get your pre-money valuation, then the investor will get 1 in 6, which is 15%. So the formula generally is, and this is a good way to think of it, which is over the life of your startup, you want to raise 3 funding rounds, such that after the last round, your business is now profitable and you don't need to raise again, or you're ready to sell and everyone makes a great return. So if you raise 3 rounds each time at 3 to 5 times the valuation of the last round, and each time raising 3 to 5 times the amount of the last round, then after 3 rounds, if you've diluted 15% each round, in other words, each round valuation is, pre-money valuation is 5x the amount you're raising, then as founders, you will still have 55% equity. If you start giving away 20% or 25% equity in each round, after the third round, the founders will be minority shareholders in their own company, and the investors will control more of your company than you, which is a bad idea. So standard patterns, in the same way I said that a Delaware C Corp removes friction with investors. Likewise, yes, you could say I'm looking to raise 5 million on a 25 mil valuation, and you may be able to pull it off, but you may spend months kissing frogs, so to speak, trying to find those perfect high net worth investors, when you may be much better off raising a smaller amount and repeating it and using that money to grow. Because for most founders, you don't literally need $2 million today. If you had $200,000 today, you could hire those people you wanted and stop paying yourself a salary and use that money to grow the business. So we're going to be out of time in a minute. What I'm going to do is I'm going to jump to a few questions, if there are any questions in the chat. All right, so Jonathan says +1 on fundraising. 42% of startups fail because they don't build something customers want. Okay, great stat, Natalie. Other reasons they fail are founder fallouts, can't raise money, spend too much money and run out of money, and so on. All right, website communicates. And sorry, I only saw the audio piece now. Okay, all right, good that some people could hear. All right, now, before we go, and Natalie, do you tell me, do we have a hard stop or can we talk for a few more minutes? In which case, you can remove my spotlight and then everyone can ask questions. And by the way, just before we do that, I'm delighted to answer all questions here or afterwards. I've dropped my details in the chat. It's Anthony Rose on LinkedIn, or you can drop me an email, anthony@seedlegals.com. And I'm not here to plug Seed Legals, but if you are fundraising, it's a platform to help with all of the things that we've mentioned with the team and the platform. All right, so questions. I think, Olivia, can an investor be a lead or following investor depending on the alignment of a company with their investment thesis? It's a very good question. I think it's certainly not impossible, but I think generally some funds just like to lead. Some will not lead, they will only follow, and some will lead if there's no other lead, and they're okay either way. Why won't somebody lead? There are a few reasons. One, they just don't feel qualified to pick a valuation, decide the deal terms, and they just want somebody else to do it. Number two, another indicator is they're just not that confident about your business. And if they see somebody else come along, then okay, fine, we'll come along. So it indicates a certain lack of conviction as well. And one of the problems that founders have, and I would be surprised if everyone on this call doesn't run into the same problem, is for your first funding round, you're generally raising with safes. So let's say you want to raise 500K. There are two ways of doing it. You can get, let's say, 10 people at 50K each, and all of them say, I will only invest my 50K once you've got a lead investor. And this means you've got no money until you magically find a lead investor. But your goal is to persuade them to go, okay, we'll get a lead later, but are you okay to come in now with the safe, and I'll give you a discount and a cap and so on, because you really need their money now. And if you can shop around and you can get enough investors to give you money on a safe without waiting for you to find that lead first, that gets you out of the catch-22 and gets you some money immediately, which is what you really want to grow your business. So one reason often why investors might say, come back when you've got a lead, is because you've told them you want to raise too much or too high a valuation, and it just doesn't sound right. So imagine if you're raising 500K, an investor might invest 50K. They're thinking that's like a tenth of the amount you want to raise. You only need to find a few more people and you've got enough money. So they might be okay to come in immediately without waiting for others. But if you tell them you're raising $5 million, they're going, I'm 50K of that. I'm like nothing in the scheme of things. The worst is I put money into your business. You can't raise the 5 million you told me you need. And then you're going to be out of business and I've lost my money. So if you tell people you're raising a large amount, their natural inclination is to go, call me when you've got everyone else. And so often raising a smaller amount, or even telling people you're raising a smaller amount, you can still keep going, might be the thing that gets them on board. All right. Question from Rohit. I'm an immigrant currently on a CPT visa. What are my options if I have to establish a company? Rohit, I totally don't know. And I make sure I never offer advice with visas, because if it goes wrong, the ICE people take you away and I can't be responsible for that. I'm not going to offer any visa advice, but I think that's something that is Googleable. Or if you drop me a note, ping me on LinkedIn, I know an immigration firm that I can connect you to, and they may well answer that. All right. Any other questions?
Deepak has his
I have
hand
one.
up. Oh, yeah.
Hey, thanks. So for most of us, I want to make a fair guess that we are in pre-stage stage, pre-seed stage. We'll be raising through safes. In your experience, have you seen, and like you said, 10 checks of 50,000 or 20 checks of 50,000 based on what you're raising, people asking for different valuation caps. So I've heard founders say, you know what, I started with a 5 million cap. And then as I started adding more people on the table, I started increasing my valuation cap. Do you see that practically happening quite a bit?
Yeah, absolutely. And I think the valuation of your company reflects the stage that you're at. For an investor, and by the way, one important thing to keep in your mind is for an investor, it's all about minimizing risk, because most startups go out of business. So they want to see a big market opportunity and they want to de-risk the fact that you're going to get there. So the least risk for an investor is you already have revenue and a team, obviously, because you've shown you can build it, but that's no use for you because you're not there yet. So the going step back is you've built it and it's launched and it's got users, but they're not paying anything. And going a step back, you've built something and it's not live yet. So where this links to your raising with safes, the first investor who's in with the safe, maybe you've built very little at this point, and now you're using some of that money to get a team on board, and you've built more and you've got more validation, and that reflects your valuation going up. So as you start talking to investors, you basically can go with one of two strategies. One of them is you say, I'm raising $1 million in safes, and I plan to do that over the next 3 months, and everyone's going to get the same deal terms. And you treat that like one funding round and they all get the same deal terms. And in a sense, that keeps things much easier because you tell everyone it's essentially one round. And you don't find that the later investors now start being unhappy that someone else before them got a lower valuation and so on. Or strategy number 2 is you start and you say, all right, this week, I think the valuation is X. I'm not going to change it every day because that just gets insane because I don't have enough to explain how it's different. But in 2 months' time, it might be increased. The good news is you've got quite a lot of flexibility on this. I think what you want to avoid is you talking to Alice and Bob, and Alice, you're telling 10 million, and Bob, you're telling 8 million. And then Alice and Bob get to talk to each other, and then there's much unhappiness. So you probably want to, if you're giving anyone a reduced or increased valuation, there needs to be a really good reason for it. And one is the passage of time. And the other one, which often an investor will say, is I'm going to give you advice and I'm going to do intros and I'm plugged into the B2B partners that you're looking for and so on. And so I'd like you to give me a better price on that. And you could, or you could give them the regular cap price, but maybe give them some stock options or something like that instead as an advisor, and make those stock options linked to their performing, so they don't just make up stuff going, yeah, I'll do stuff for you. But no, if you need to spend a day a month and you need to make 3 intros a month, and your your extra stock options are going to vest over 1 year based on your achieving these milestones. And then if any other investor asks, why is this person getting extra stock? You can go, they're an advisor and they've signed up to do these things for me. So they, as an investor, they got the same deal as you, but they're also an advisor getting extra stock options. All right. So
Thank you.
Thank
any
you.
other questions? All right.
Yeah, I think we're at time, but thank you, Anthony.